Hey, I'm Hervin Pesa, I'm a financial planner, and in this video we'll talk about a debate just as heated as the whole MJ versus Kobe versus LeBron as far as who the real GOAT is. I'm talking about the passive versus active investing debate. Look up any personal finance forums or any investing forums and you'll know just how personal this debate gets. My aim in this video is to educate you about the merits of both schools. If you're watching this video, I hope that you already understand how important investing is and you're simply looking for the best path forward. The goal obviously is to help you understand why this battle is so heated and why understanding the difference between these strategies can make you a better investor. First, let's clarify what it means to invest passively and what it means to invest actively. An active investment approach means using research, analysis, and some sort of philosophical viewpoint to look at opportunities to beat the market or beat the benchmark. Beating the benchmark of the market is known as getting alpha returns. There are really two primary decisions an active investor can deploy when it comes to investing. One is timing. Number two is security selection. Now, earlier I said philosophical viewpoint because there's different strategies that hinge on different beliefs when it comes to active investing. And they tend to butt heads and oftentimes they come to different conclusions. The main example I can give you is value investing versus growth investing. Value investing uses analysis to look at an asset's intrinsic value and then compare that to the price that it's trading for right now. A value investor looks for undervalued investments and shares that are trading for what they believe is under what the company should actually be worth fundamentally. Growth investors, on the other hand, look at current revenue and revenue growth, and they're expecting that this company would grow continuously and thereby having bigger returns in the future, increasing its value over time. See, a company that trades for more than its intrinsic value in terms of its price to earnings would be a sell for a value investor, while a growth investor may see this as a buying opportunity if the future earnings and the growth potential is deemed to be high for a growth investor. So a growth stock picker would tend to buy shares with higher PE. Now, regardless of the methodology, the aim is the same. It's to beat the benchmark. Now let's talk about passive investing. To do this, I'll have to explain market efficiency. There's a theory known as efficient market hypothesis that states a stock's price already reflects all available information and its true value is already reflected in its price. This then makes alpha impossible. So instead of buying individual stocks or bonds, a passive investor will focus on diversifying across a wide range of investment picks across different industries and across different sectors. The most common way of passive investing, it's become synonymous, is index investing. We already did a video about indices a few days ago, but to put it simply, an index investor will buy the whole market or the whole benchmark instead of trying to beat it. The most cited index is the S&P 500, which represents the US large cap as an asset class. When you invest in the S&P 500 as an index, you're buying a fund that holds all the S&P constituents in the same weighing as the S&P 500 index. So let's put them head to head. How come they have such differing viewpoints? See, passive investors believe that it's difficult to find mispriced opportunities, therefore it's not practical to do so. While active investors believe that through research, data, and analysis, they can find those opportunities. There's evidence in both cases being true in real life. See, with highly researched and highly visible shares, like the S&P 500 constituents, information gets priced in rather quickly. But of course, this also assumes that all investors view the information the same way. This assumes that all investors are rational and efficiency seeking and they all want to maximize opportunities. Here's the thing, behavioral economists will point out that these hyper-rational beings known as econs exist in textbooks, but not in real life. So an active investor can quickly point out investor irrationality as a source for price and value mismatch. That's why we have bubbles in the stock markets, in real estate, and other assets. Remember, price is what other people are willing to pay, while value is what it's worth. Having the ability to reconcile them is actually quite a gift. Just imagine trying to buy something that you want to pick up from Facebook Marketplace. Something that you're interested in. Don't actually buy it, but just scroll through and undoubtedly you're gonna see listings where you think it's not worth that. And on the other hand, there's gonna be listings where you are tempted to hit that annoying, is this available preset? It's very difficult in real life to see where price and value is. So which investment methodology is better for investors? See, the truth is we can probably cherry pick data that supports either camp and present them with conviction. But we believe in using passive strategies and index funds that when combined together get our clients the results they actually need for their financial goals. And we want to put them in investments that they can actually hang on to by creating the right asset allocation instead of worrying about specific security selection or timing. So that's my bias. Here's the thing, there's data to back this up. Since 2002, SP Global has been publishing an annual report called the SPIVA scorecard. It's the S&P index versus active, I think that's what it actually stands for. S&P index versus active. As the name suggests, it compares the S&P indices against different actively managed funds in different strategies. Every asset class is compared to the appropriate index benchmark. So large cap funds are compared against the S&P 500, while small cap is compared to the S&P 600 small cap. The report then looks at the percentage of funds that underperformed their index or their benchmark. The thing is, the data is also segmented in different asset classes, and that addresses the argument that some asset classes are better off being managed actively compared to others because there's less efficiency in some of these asset classes. Therefore, it's probably better for you to hire a manager that's smart enough or with enough resources to get an edge in these specific assets. I used to believe that until I dove into this data. See, the claim is in these less efficient markets, you're better able to achieve alpha because information doesn't flow the same way. Let's see if that's actually true. This is the 2020 scorecard. You can Google it. It's publicly available information. I have to cheat. There's a lot of info here, so I got to read through my notes. See, the 2020 report says that 60.3% of the US large cap funds underperformed the S&P 500 and 50.7% of mid cap funds underperformed against the mid cap index. On the small cap segment, it's a little bit better, 45.5% underperformed. See, last year's data shows that if we just looked at this alone, there's potential to find funds that beat the market. See, with the S&P, roughly 40% of large cap funds actually beat it. With the mid cap, about 50%. With the small cap, about 55% of funds outperformed the index. So that's kind of promising. I went down this report and looked for the asset classes with the least underperformance. So I ended up looking at the small cap growth. Only 13.7 underperformed the index, and the real estate, only 24.7% underperformed the REIT index. Meaning in this asset classes, it seems like majority of fund managers actually beat the index. Well, would you agree that 2020 was a bit of a strange year? So it's probably not wise to make long-term investment decisions off of a 1-year period, which could potentially be an outlier. So let's look at persistency and what the percentage of funds actually beat their benchmarks over a 5-year period. In the large cap, 75% underperformed the market. In the mid cap, 59% don't beat their index. In small cap, it's 65% that can't clear the mark. So let's go look at our two outliers. In small cap growth, 32.8% underperform. So it seems the majority of these managers actually still beat their index. In real estate, 50.59 underperform. So under this time horizon, it seems like it's possible actually with these two asset classes, there might be an edge for active management. So let's go a little bit further. Let's go 10 years. 82% of large cap funds underperform. For mid cap, 72%. For small cap, 76%. And for small cap growth, 57% lose to the index. And finally, with real estate, 76% don't beat the benchmark. So you may be thinking, it seems like it's worthwhile then to hire active managers in these specific asset classes. It might give you some edge. That's ultimately up to you. I'm just reading the data here. This report also shows survivorship in style or execution consistency. See, with small cap growth, only 62% of the original funds survive after 10 years. And out of the survivors, only 77% are consistent with the original strategy that they started investing in. With real estate, 80% survive, so it's a little bit better. And they were fairly consistent, with 78% of the fund still executing the same style when you start investing 10 years prior. This shows me that there's still a risk in choosing a fund that fails or drifts from the strategy that we're employing them to do. Maybe you do want to go through this exercise and you want to look for actively managed funds. Maybe you have some sort of special fund picking skill. How would you find a good one? You research? Your advisor researches for you? That's absolutely possible, but just don't get starstruck. What do I mean by that? When you look at funds, any funds, mutual funds, ETFs, they have a 5-star rating system provided by Morningstar. Countless investors and some advisors rely purely on this fund rating. It's a quick and easy way to see where your funds stack up. I mean, who would want to buy a 1-star fund when there's a 5-star fund available? The issue is it's primarily historical looking. It's nice and simple because there's a lot of options for us to look through. So this star rating helps whittle it down, and you hopefully just look at the cream of the crop and you analyze your options there. But this saying should sound familiar to you. Past returns don't guarantee future performance. In this rating system, that held almost entirely true. See, the Wall Street Journal studied these highly rated funds and looked at where their ratings are 10 years after. Well, only 14% of them kept the 5-star rating. That's because the original rating system is still heavily reliant on historical returns. So even if there are asset classes where it might be possible for you to find funds that are actively managed so you can outperform, chances are it's gonna be difficult to even find the right fund. And the funds that you find, they might not necessarily repeat that performance again and again and again and again for you to consistently beat the index. Let's go back to the SPIVA one last time, longest term available here. Over 1 year, 57% of funds in all classes don't beat the index. Over 5 years, about 2/3 fail to outperform. After a 10-year period, 83% don't beat their index. Over a 20-year period, which is the period or time frame you should really be looking at if you're around my age and you're planning for retirement, 86% of all funds in all asset classes underperform the index. That's pretty compelling. Okay, look, is it possible to beat the market with an active strategy? Of course. I think the data that I just spewed all over this proves that it is possible. But the issue is it likely that you can consistently do it? It's really hard to do. See, even if it's possible, it doesn't come cheap. Most actively managed funds have MERs or fund fees that are over 1%, while passive funds have MERs that are around 20 basis points or 0.2%. See, effectively, for the two strategies to be comparable, the actively managed fund must clear 1% more in gross returns compared to the active comparison. See, we talked a lot about the MER and mutual funds, so look at video 20 in this series. I'm not going to repeat a lot of that stuff. I'm not saying you should never ever invest actively, and there are no options that warrant active management, but here's the issue. We tend to get in our own way. That's because there's no active strategy that is good for every single market. There's a strategy for every season, so to speak. So you need to understand that if you want to employ an active strategy, whether it's value or growth, you have to employ it ruthlessly. You can't be a value seeker today and a growth investor tomorrow. Even the best managers and quants go through periods of underperformance. But overall, a lot of these successful stock pickers or value pickers, you can look it up, just type who the most successful value investor is, you're probably gonna bump into Warren Buffett. Thing is, they stick to their plans and they get decent long-term returns, but Warren Buffett is known for holding a lot of cash. And when you try to beat the market, you would have some non-correlated returns. This means there's going to be years where your performance or your overall portfolio is going to be lackluster compared to the whole market. Even if you're extremely successful at market timing, you have to have the patience in waiting for opportunities to buy. And most people would either jump too soon since there's no action and they get impatient, or when the opportunity comes, they'll be stuck in status quo and they'll be too scared to execute on the trade. That's what separates a lot of these successful long-term investors that are active at selecting their positions compared to the people that are always jumping in and out. So what's the right strategy for you, or what method of investing is right for you? Ultimately, That's up to you. If you have the confidence to beat the market or the ability to find the funds that will, then maybe you can become an active investor. At Aware, we don't believe that the cost of trying to beat the market is worthwhile for most of our clients that we help. One of our beliefs is that beating the index is not really a valid financial goal. Our goal for our clients is to get them to where they want to be with the right level of savings that allows them to live the lives they want, to give them choice. The good news is for most people, as long as they start early enough with the right strategies, the right understanding of taxes, understanding the right asset allocation and asset location, as long as they have the right savings to start and the right discipline to get going, they're gonna hit their goals, whether it's retirement or otherwise, without having to beat the S&P or any index. We use personal goals as our benchmark, not the market. So this video was a little bit difficult for me to shoot, to be honest. Obviously, I try to do my best to be non-biased, but I think it's pretty evident that I favor passive investing for most people. But the truth is I'm a bit of both. In real estate, for example, for our holdings, we're always looking for good deals. We're always looking for an opportunity to buy mispriced units and an opportunity to maybe fix them up or make them better, though I don't have as much time to do that nowadays as I focus in this business. But I'm sharing that to kind of just share the reality that I'm a little bit of both, and most people probably are. You can't be an extreme active person trading all the time and be successful. Sorry. And even if you're using passive funds, like I said, we still need to be able to blend them with the right assets and the right strategies, right? So you can't completely be passive, and staying still is actually quite difficult. There's a natural urge for us to jump in and out, so that requires a little bit more work for investors. If you're a passive investor, you're still not insulated from volatility, but you just need to understand history and how all this stuff will kind of work long term. Well, until tomorrow, stay aware, take control. I love y'all. Bye. Watch yesterday's video over here, watch the playlist over here. Be sure to subscribe. See ya.